What's up, traders? In today's video, we are going to be discussing how to correctly identify a valid break of structure. So stay tuned. Now, towards the end of this video, what I'll be doing is performing a little bit of a market forecast here on Euro Yen, kind of just to apply some of the concepts that I'm going to be teaching you in this video so that you have more of a practical understanding and more of a practical representation of what we're going to be talking about. All right, so make sure you stay tuned. All right, so quite simply put, right, smart money trading, the smart money approach to trading is essentially a trend following strategy. What it entails is it entails identifying the underlying trend, looking for high value areas where we can then look to get involved to continue with the underlying trend, right? So whenever we're talking about smart money, we're talking about order flow, we're talking about supply and demand trading, a bunch of concepts that all form part of this approach that looks to follow the underlying trend. Now, that does not mean that you can't find some nice counter trend moves. One nice thing about smart money trading is that there are many instances where the market gives you opportunities to sell to buy or buy to sell. But it is important that you know exactly that you are in a counter trend move, all right? So that you don't aim for the stars. Here we have a very simple markup of some of the elements contained in a smart money approach, with the break of structure being one of them, right? So there's a bunch of different things that need to fall in place, a couple of confluences that you need to have essentially in order for you to trade a high value setup, right? One of them is obviously, and the most important one is obviously, a break of structure. You need to have some imbalance, you need to have some liquidity, you need to have a valid supply or demand zone or a valid order block. And then the last thing you want to have is, and one thing that will add to the high value area that you want to be trading from, is you want to ensure that you are either buying from a discounted area or selling from a premium area, right? And your Fibonacci tool is essentially what will help you with that. So if you're looking to go long, you want to make sure that you're only trading supplies, or you're only trading demand zones underneath the 50%. And then if you're going short, what you want to be doing is you want to make sure that you're only trading demand or supply zones that are above the 50%, right? Now, I will be making videos on each of these elements. I won't be diving too deep into these, because what I want to do is I want to give you guys really simple, basic rules that you can apply to your trading using smart money concepts. Because at the end of the day, a simple strategy with a few basic rules is the best type of strategy to result in consistent trading and consistent execution of the markets. Okay. Now, the most important thing that you need to be able to do before you can even start trading smart money concepts is you need to be able to understand how to identify a trend. Okay. In this particular markup, you can clearly see that price action is bullish, which is why we're looking for demand zones to continue with that underlying bullish move. Okay. Now, how do we know that this is a bullish market? We know it's a bullish market because price action has been putting in higher highs in here, and price action has been putting in higher lows. Now, you won't always have a market that is as clean as this particular markup here, right? Because the market is imperfect essentially. It's full of randomness. But you need to be able to know when to cut out some of that randomness and focus on the key elements of the structure. So for example, and I'm sure if you're watching this video, you're probably trying to figure out exactly what constitutes a valid break of structure, because in the past you've been burned before, right? So as you can see here in this particular market, price action again is clearly pushing bearish, okay? But how many times has this happened to you where you identify that price action is pushing higher, you get your valid break of structure here, right? From that valid break of structure, you identify a valid demand zone, and then you place your trade. So you go for a risk entry right at the top here, you place your stops just below the low of that demand zone, and then you either aim for this particular high or this particular high. And then what does price action do? It taps you in, it immediately taps you out before continuing the underlying trend. Now, it does not mean you identified a wrong or an invalid break of structure, because for all intents and purposes, this particular break of structure is valid, right? But what you fail to realize is that there was this particular demand zone slightly lower down that price action had not mitigated yet, that still had a little bit of imbalance left over, which was targeted before the continuation of that move up, right? Now, just because you took a 1% or a 0.5% loss on this particular trade does not mean that you executed your plan poorly, right? Provided you had the break of structure, the imbalance, the liquidity, and the valid demand zone, this would be a good trade, okay? All you would then have to do is you would have to, at the end of the week or at the end of your trading day, journal this particular setup, understand what happened here, and then go into the next trade more confident and more prepared to tackle what the market throws at you. Because in this particular markup, and when we perform that analysis on euro yen, you will see that this does happen sometimes. What happened here is that price action, as you can see, was putting in those higher highs, okay, and those higher lows. But when price action violated this particular higher low, this higher low was still in place. So even though we had a slightly deeper pullback, this is sometimes referred to as a complex pullback, even though we had this deeper pullback, the overall underlying trend still remained bullish. And that's why I have developed just 3 very quick rules, 3 steps that you can apply to your trading today to help you identify these valid breaks of structure, okay? And quite simply, these 3 steps are the following. What you want to do is you want to focus on your higher time frame external structure, i.e. the daily or the 4-hour chart. You want to identify the underlying trend. So let's say, for example, you are a intraday trader, right? So you day trade, you focus on your lower time frames, maybe your 15-minute, maybe your 5-minute. At the start of every trading day, what you need to do is you need to identify what your higher time frames are telling you. So whether your higher time frame is the 1 hour or the 8 hour, the 4 hour, whatever it is, before you look for any entries on your lower time frames or your trading time frames, you want to make sure that you identify your underlying trend. So for example, this particular trend here would be a 4-hour trend, and then this particular demand zone would be a 1 hour or 15-minute demand zone that I have marked out, that I have refined on my lower time frames, and then I'd be looking for potential entries in here. All right, now obviously this particular markup, it fails, but you get the gist of it. All right, the second step that you want to do is you want to mark out your swing points. All right, because your valid breaks of structure occur at your swing points. So what are your swing points? Your swing points are essentially, in a bullish market, your higher highs and your higher lows. And you know that in order for this bullish market to continue, you want to see a violation of those higher high swing points, okay? If the market were to reverse bearish, you would then be looking for a violation of these higher low swing points, right? So what we mean by that is mark out your swing points is you want to know exactly what those higher highs and higher lows are, because you know that whenever a higher low is violated, the underlying trend continues, and whenever those higher lows are violated, your underlying bearish trend is violated. And then you could easily see price action go from a bullish state to a bearish state and then back up to a bullish state. All right, so very simple stuff. And then finally, after you have marked out those swing points, what you want to do is you want to then go ahead and locate the origin of the break of structure in order to identify your valid order blocks or your valid supply and demand zones. Because once you have now identified your break of structure, you are able to locate your demand zone or your supply zone, your order block, and that's when you start building a case for entry, because now you've got a high value area of the chart that you want to look for, right? And again, remember, you also want to make sure that you're constantly looking out to make sure that you're buying at discounted prices and you're selling at premium prices, all right? So now that that's done, to end off the video, what I want to do is I want to perform a quick little market forecast here on Euro JPY, using some of those rules, using some of those steps to show you guys just how simple it is to identify a valid break of structure. So just for reference, I am recording this particular video on the 4th of May 2022. The time has just gone 3:30 in the afternoon here, local time. Now, whenever I start analyzing a chart for the first time, I always start off on my weekly chart. And what I like to do is I like to mark out any swing highs and any swing lows that price action has not interacted with yet. Because what this does is it kind of helps you eliminate some of the randomness that may be seen in price action sometimes. And it gives you a clearer picture of what the underlying trend will look like, all right? So the reason I have marked out these two particular swing points is because if we bring on our tool here, you can see that from this particular point in August 2012, we had a massive bullish rally that pushed up to this weekly swing high. We did have a little bit of a pullback, okay, that led to this particular swing low. Now, I like this particular swing low because it is more relevant to recent price action. And then we've obviously been pushing up, right? So it makes it a little bit easier to help you identify what the underlying trend is, right? Because you can clearly see that from this particular swing high, price action moved bearish, excuse me, before a period of bullishness in here. Okay, why? Because we're putting in those higher highs, higher lows. That was soon followed by, again, another period of bearishness that created this particular swing low. And then now, more recently, we can all agree that price action has been pushing bullish in here, right? As you can see. Now, if we just zoom in here on this particular bullish push here, which we have now identified that the market is currently in a bullish trend, we can start looking at and using those 3 steps that we outlined earlier, right? And the first one is you want to obviously identify your underlying trend and you want to focus on your higher time frame external structure. So here on the weekly time frame, what we can clearly see is that price action has been pushing up. So here we have proved to ourselves now that we are in a bullish trend, right? The next thing you want to do is you want to mark out your swing points, right? And as you can see, these are my swing points outlining the higher highs and the higher lows that price action has been putting in. Once you have marked out your swing points, what you want to then do is you want to mark out those breaks of structure, because you can clearly see that from this particular swing low, price action pushed up, created a new higher high. We pulled back to form a new higher low, and then we've had a really strong bullish phase of the market which violated this particular swing high. So we can now mark out this particular break of structure, all right? So once we've marked out our break of structure, the next thing we want to do is we want to identify where that break of structure originated from, okay? And where that particular break of structure originated from would be this particular candle in here. Now, don't be scared to mark out candles on your higher time frames when you're performing your analysis initially, because the lower you go, the more you can refine that particular zone that you mark out, all right? So what we're going to do now is we are going to identify one more break of structure, which is valid in here, together with another origin of that break of structure, which would be this specific area in here. And notice how your breaks of structure more often than not originate from the previous swing point, which is why it's so important to be able to identify those swing points. Now, what we're quickly going to do is we're going to drop down to our daily chart. And what we're going to do is we are going to refine these particular zones, these particular demand zones that we mapped out. So you can clearly see here, as soon as we drop down to that daily chart, automatically we are able to refine this weekly zone all the way down to this particular indecision candle. And we are able to mark that particular zone out, right, for future reference. Remember, marking out when you're performing technical analysis is so important. We're able to mark that out as a daily demand zone, and we now automatically know that this particular zone, this particular area of the market would be a high value area for us to look for potential continuations of that underlying bullish trend that we identified on the weekly chart, right? And again, we can also, this other weekly zone that we identified, we can also go in and we can refine that particular zone even more. Now, with this particular demand zone, it's a very interesting one because you've got what looks to be another potential order block that formed in here, but we're going to save that for another video. For now, we're just focusing on breaks of structure. And it's that simple. Just like that, in 3 quick and easy steps, we've been able to identify 2 high value demand areas where we can look for potential continuations of the underlying bullish trend which we identified on the weekly chart. So with Euro Yen, obviously this is weeks and weeks away, but we could easily see price action pulling back towards this particular demand zone, which sits just around the 126 even handle number, which is beautiful. And then if this particular demand zone is mitigated and fails, we could see price action push down towards the lower demand zone, which sits around 122,400 before that underlying bullish continuation. All right, we're not saying that these 2 zones should hold up and will hold up, but we can definitely anticipate that they may hold up because we've identified them as high value areas based on a rules based approach. All right, so if you guys enjoyed this video, please make sure that you hit that like button. I hope you were able to take some value away from it. I am going to be trying my best to bring you a lot more videos on each of the specific elements contained in the smart money trading approach. So if you enjoyed this video, please make sure you hit that like button, subscribe to the channel so you don't miss out on any future content. Head over to the channel to watch some of our previous videos where we perform market forecasts on some interesting pairs. And I appreciate you guys so much for watching. I'll see you in the next one.